Hey folks, it's Simon here with Tao Daily for Tuesday the 17th of September 2024. Big week this week. We've got retail sales today before the market, and we've got the FOMC interest rate decision tomorrow. Firstly, on retail sales, this sometimes is an economic data point that the market only pays passing interest to. But right now the market is going through a bit of a growth scare, all right? So the market is going to be looking at things like retail sales to try and determine whether this growth scare turns into something more serious, i.e. a recession. Having said that, FOMC will still take center stage this week. Market probabilities or expectations around a rate cut have swung around from Monday to Tuesday. Monday we were 50-50 between a 25 basis point cut and a 50 basis point cut. Today, 2/3 of the market is expecting a 50 basis point cut. I must be the only person in the world that doesn't really care whether they do 25 or 50, but clearly there is some room for disappointment with the market if they only deliver 25. Just some comments in terms of market structure. The S&P here looks pretty bullish, all right. It's butting its head up against the all-time high again. Now this is either going to be a big breakout or a big old triple top, and the market's reaction to FOMC will probably determine that. If we look at the Dow here actually looks bullish, all right. That's making new highs. So the Dow is kind of the most bullish of the major indices. And if we look at the NASDAQ actually doesn't look too great. It's not awful, but we're certainly not in an uptrend. We've got 3 consecutive lower highs. And if you want to get even slightly more bearish, you could look at the semis. All right? The semiconductors typically lead the NASDAQ. Here we've got a succession of 3 lower highs. But not only that, it's also below its 50-day moving average. So SMH actually looks more bearish than bullish here. Right, so that to me is a warning. Now the sectors that have been performing really, really well are things like real estate, that's at a new high, utilities is at a new high, and both of these are looking extended by the way, and consumer staples, which has made a new high as well. They are defensive sectors. They are the sectors that big money hides in when the economic outlook is not that robust. The more cyclical sectors like consumer discretionary, I mean, it doesn't look awful here, but it's not making new highs. Tech, which is one of the growthiest sectors, it's in a downtrend, much like the NASDAQ. Well, it's not in a downtrend. It's making lower highs, but it's also making higher lows, right? So it's in a congestion zone. But the point being that the growthiest sectors are underperforming the defensive sectors. And that's not bullish. Now, as I said last week, in a growth scare, sectors like utilities and consumer staples and healthcare can continue to rally, and sectors like tech and consumer discretionary will continue to underperform. But if that growth scare does transition into a recession or fears of a recession, that's generally when everything will start to fall. Everything except for bonds, that is. If we have a look at TLT as a sort of bond proxy, that is acting pretty bullish here as well. So in summary, market action here looks reasonably bullish on the surface, but when you scratch beneath that, the rotation that we've seen is not bullish. And given how extended some of these defensive sectors are, I wouldn't be surprised to see them pull back. And if we don't see tech and semiconductors rip higher, that really could put some weight on the overall market. Let's see how retail sales prints today. If that's another disappointing figure, that could be another step from growth scare towards recession. That's what I got for you today. I hope it helps, and I'll catch you tomorrow.